Hey everybody, David Lenevieux here with Rockmore Wealth Management. This week I'm going to start a two-part series on life insurance. Why are we going to talk about life insurance today? Well, it is a major part of your overall financial planning. Because think of it, you could invest tens of thousands of dollars with us over the course of several months. But if you were to unfortunately pass away or get hit by a bus in the interim, that tens of thousands of dollars is really not going to mean much to your family if you're gone and your income earning potential over the course of your lifetime is gone. Because for, really realistically, a couple dollars a day, we could insure your life for hundreds, even millions of dollars to help protect your family in case something were to go wrong. And it goes the same to say with disability insurance as well. We do believe that they're two very integral parts of your overall financial planning. So when it comes to life insurance, who needs life insurance? Now, this is obviously our opinion, but if you are married, if you have children, if you have people that are dependent on you, or if you want to guarantee that you give a certain amount of money to somebody when you pass away, or you have a lot of money and you're going to have a very large tax liability later in life, in our opinion, you need life insurance. Now, the next question that comes, or the next statement that sometimes we see is, oh, don't worry about it, I'm covered. I have coverage through my employer, my work, my association. Unfortunately, many times that we see, the coverage isn't even close to what you will need. Generally, you'll get $50,000, maybe one-time salary or up to 3 times salary through your group coverage or your employer. But as you'll see, that's generally never enough. And if you have mortgage insurance or loan insurance through your bank, I will tell you that there's a much better and a much cheaper way to get your life insurance. And there's all sorts of articles that you can research online about that. But let's stick to getting your own life insurance, because the next question that generally comes up with us is, well, how much life insurance do I really need? And many people don't have a good answer to that. Now, in my opinion, you need enough life insurance to cover off your liabilities and so you can sleep well at night. And when it comes to this, there's actually 2 very simple ways to determine how much life insurance you need. Now, don't get me wrong, there's no perfect amount of life insurance. There really isn't. And nobody has come to us when a loved one has died and said, I wish I didn't have this much life insurance on my loved one. We've never had that occur. But there is a reasonable amount of life insurance that you can carry. And one of the simplest formulas that exists out there is simply take your salary and times it by 10. So if you have a $100,000 annual average earnings, you need about $1 million of life insurance. If you have $50,000 in earnings, you need about $500,000. Now, this is an extremely broad-based, simple way of doing the calculation. But realistically, in all my years, it really hasn't been that far off. Now, the way that we do our needs analysis for our clients is a little bit more in depth. And I'll go through some of the questions that we ask everybody to kind of give you a feel of what it comes down to when we're really looking at life insurance coverage. So every question that I go through here, it's a personal question and there's no right or wrong answer. We're simply asking the questions to see what's appropriate for your given situation. And any answer that you give us suffices. So the questions we generally ask, and the first question we ask is, well, what is the cost of dying? Now, once again, there's no simple answer to that. Most life insurance companies offer a minimum of $25,000 of coverage, and that's assumed to take care of funeral expenses, accountant fees, lawyer fees. But what it may not take care of are tax implications when you pass away, because there's probate when you pass away, and there's the potential for capital gains tax as well. Usually the more money that you leave this earth with, the more you're going to be taxed. And a simple way to estimate your amount of terminal liability is, once again, take that salary and divide it in half. And that is a reasonable estimation of what you might owe when you pass away. Now, as a side note, if you're married or have a spouse and you pass away first, then the majority, if not all of your assets will pass over and roll over 100% tax-free to your spouse. It's on the second spouse passing when the majority of taxes become owing. Now this is oversimplified, but this is a general talk. The next question we'll ask is, do you have half a year's or 6 months worth of bill payments put away in a liquid accessible account? Because if you don't, we're going to recommend that you add this to your life insurance total as well, because we don't want to leave our loved ones in a lurch trying to pay bills when somebody passes away. So same formula, take your salary and divide it by half, and we're going to add that to your life insurance amount. Now, one of the ones that is fairly obvious and what most people would be aware of is, well, what's my mortgage? Because if I pass away tomorrow, reasonably we want the mortgage to be paid off so our family doesn't have to worry about it. So we will add that to the amount. And if we don't own our house, we'll say, well, what's our rent? And what will it cost us to pay in rent over the next 10 years? And it'll usually come out to a very similar amount. Beyond our mortgage, we're going to ask, well, what other liabilities do you and your family have? Do you have student debt? Do you owe money on your cars? Do you have outstanding lines of credit? Because once again, we're going to try to leave the family in the best financial position as possible. Now, beyond our debt, our next, or maybe even our biggest liability in a lot of people's case is actually our children. Now, don't get me wrong, our children are wonderful and our families are wonderful, and I have 4 of my own. However, in this case, it represents a huge liability to my family if something were to happen to me tomorrow. So we want to ensure that my spouse, my wife, can raise those children without ever having to worry about money and without ever having to worry about going back to work. So one of the simple things you can actually research online, and it's been shown many, many times, is what is the cost of raising a child from 0 to 18? And this includes their sports, their food, their clothing, their housing, everything. And the general consensus is just over $200,000 American. Now, once again, this is a very broad figure, so I put it a little bit more simply. On an average month, does it cost you closer to $500 a month to raise your child or $1,000 a month to raise your child? Because if you're closer to $1,000 a month per child, you're going to be closer to $250,000 of liability from the ages of 0 to 18. If you're closer to $500 a month, you're going to be at $125,000 per child from 0 to 18. And if you're somewhere in the middle, just do the math. And then we take how many years until they reach age 18, do the math, and add that to the amount of life insurance we need. Now, beyond raising our children to the age of 18, many people want to ensure that they can get put through a post-secondary education or a trade program. And we want to put away some money for that as well, so we'll add it to the life insurance amount. And this can vary per family and per situation. And we always ask the question, what do you think would be appropriate? $20,000 a year per year for post-secondary education? $10,000, $50,000? It's all up to the individual's family. And then we would record that information. And then the final question that we ask is, if you or your spouse were to pass away tomorrow, would you need to replace their income for a period of time? Some people say, yes, I would. Some people say no. Because remember, we've covered off all the debt. We've paid for raising the children. We've got some emergency money in there. Now, the question becomes, after all that is paid for, do I want to go back to work? How long do I want to go back to work for? Or do I not need to worry about replacing my spouse's income? So some people will say, yes, I need to cover it for 5 years, 10 years, 1 year, or indefinitely. And so usually the calculation is take the spouse's salary, times it by 70%, because that's the after-tax value that you would receive, times how many years. And once we add all these pieces up, we generally come up with a fairly round figure. And let's pretend it's $990,000 of insurance. So that's your life insurance number. That's your number, not ours. It's based off all the information you've given us. And is that a comfortable number? Should we, maybe raise it up, or would you be comfortable with a less amount? And how much is this going to cost, of course? Now, if you came up to $990,000 worth of insurance, I am going to tell you right off the bat that we should immediately look at $1 million of insurance. And why would that be? Because assumingly it's going to cost you more money at $1 million of coverage than $990,000. Well, actually the opposite becomes true in this case. There's a very funny thing in the insurance world. I call it personally the Costco effect. And what I mean by that is the more you buy, the cheaper it gets. So just thinking of buying 24 hot dogs at 7-Eleven versus buying 24 hot dogs at Costco. Where is it going to be cheaper? Well, Costco is always cheaper because you buy in bulk. Well, life insurance works the same way. When you buy in bulk, you actually get it much cheaper. So at numbers of $100,000 of insurance, $250,000 of insurance, $500,000 of insurance, $1 million of insurance, and even $2 million of insurance, the cost per thousand of insurance gets much cheaper. And in some cases, it can be 20 to 30% cheaper once you hit those numbers. So in general, and this is very generalized speaking, but in general, $1 million of insurance is generally cheaper than $990,000 of insurance by a fair margin. The same would be true of $450,000 of insurance. Would actually be a lot more money than actually bumping up to $500,000 of insurance. So you definitely want to be conscientious of hitting those nice round numbers when you are looking at insurance, because you will definitely get a better price per thousand. That's all I wanted to talk about this week, folks. Next week, we're going to concentrate a little bit more about the types of life insurance that are available and what you in your personal situation should be looking at. If you have any questions about this, you want to get in touch with us, you know where to go, www.rockmorewealth.com, and I'll look forward to speaking to you again next week.